Feel free to grab a seat. We'll throw an extra row back here. Yeah, mostly in the Manhattan. I would love to do a prospect park team, but like half the team. So I've been on the same team since I've been on the same team since the fall of '05. There's 3 of us from the original team, and like some of them have moved up to Croton and kids, and so I can't move them back down.
Oh. Prospect.
Moving the team to Brooklyn, split the team in half.
Maybe I'll head up to Charlie and we'll share. Yeah.
Oh, that's much better. Cool, thank you.
Yeah, you know, only so I feel like but you know, they fall out of favor, and I think that's that old ways of doing business. I don't know if it's working. Exactly. Like families.
Yeah, how many are you?
I don't know. There's a lot.
There was something interesting about that.
It's awesome. That's really great. I don't think I've had any. I've been here for some Spanish. Been here for 10 years. That's my business.
Yes.
And I've been working my vertical home flow for the last 2 years. So we are creating a collaborative platform for real estate agents and investors to buy homes, sell homes, and keep the communication on everything in one place.
Yeah, but that was a good pickup today. I was reading that on the train.
I love that.
And Boston, Morocco.
Having space, empowering people to buy, communication. Is that first generation?
I get to, 4 years I felt your new US game, and I was like, I never talk about soccer, but every 4 years, you're still hanging out.
Yeah.
4 years ago,
Just be like,
Or here.
I played with Beyond, but like, I love the space of it. There is a theatrical element with the high stakes and just like, and there's like a nationalism, free, like, I'm surprised I didn't see you get excuses. I'm surprised.
22 guys on the field, 3 of whom are in the particular play. Everybody else is just John. And at most, they hit the net 6 times a game.
Yeah, it's
so
pretty infrequent.
Yeah. It's like not much better than when like
Yeah.
6-year-olds play.
Yeah.
Except they keep going. I know the world has voted against me on that, and I'm holding the like complete minority opinion there, but yeah, actually I just posted, Jerry from Laconia sent me, because I was just in a board meeting where one of my portfolio founders was talking about the fact that Gabe was on, so he was like sort of half paying attention. So I shared my views, and Jerry from Laconia sent me this tweet where somebody was like, you know, there's just like way too many people on the field. They should limit it to like 5 people, and the field should be like way smaller, and it should be completely covered with ice. And I was like, yeah, I can get behind that. That sounds really great.
Isn't that just called honking?
Yeah. Okay. So I'm sure some other folks will strap in, but we've got a hybrid event going today. So we are live on the Brooklyn Bridge Ventures YouTube channel, which actually has a few hundred subscribers now. Who knew? When you start posting content, people show up, especially during the pandemic. But super happy to have everyone here in person. My name is Charlie O'Donnell. I'm the sole partner at Brooklyn Bridge Ventures, pre-seed and seed stage fund, generally lead or co-lead most of the deals that I'm in, although I'm happy for other VCs to do the work. That usually doesn't happen, but it's always nice when somebody else pitches in and takes the lead. Focused on New York City companies across a wide variety of industries, so B2B, B2C, like consumer products, food. I've even done some brick and mortar. And yeah, there's been a lot of conversation about sort of what is the state of the market now, how should people think about the fundraising environment, whether it affects them as founders. And I thought it was an interesting conversation to get some other investors' take on this and to have a little bit of a collaborative chat. So I will introduce my co-panelists here. I'll let them introduce themselves. Evelysse, you want to?
Yeah, for sure. It's great to be here. Thank you, Charlie.
And just to make sure I don't know what the acoustics in the room are, and so since this is live, just make sure you project towards the back.
For sure. Okay. So my name is Evelysse Vargas. I'm an investor in Zeal Capital Partners, which is an early stage firm focused on the future of work in FinTech. Part of our thesis is also investing inclusively, which is to say investing in diverse geographies within the US, diverse management teams, and also folks that are working on problems that are impactful on a societal level. Really the thesis for us is narrowing the skills and wealth gap in the US. And we invest pre-seed, seed, anywhere from 250K checks to $1.5 million checks. Also okay with leading or joining in on a term sheet. Yeah, I'm based here. Our team is headquartered in Washington, D.C. though. It is great to be here.
My name's Neamonitis. I run a fund here in New York called Lakehouse. I guess first off, thanks to Charlie for putting this together. I think Charlie probably does about as much as anyone for the New York and more broadly venture ecosystem. I think as a solo GP, he definitely has kind of paved the way for a lot of us that have followed on and been able to benefit from some of the work he's laid down. So so definitely recommend that. So Lakehouse, I started about 6 years ago. Solo GP, pre-seed and seed. Typically first institutional check. We broadly invest in consumer products, services, and software businesses. So I think the way we've invested has evolved over the years. started in a lot of like direct-to-consumer e-commerce brands. I think as we've evolved, are probably doing, you know, a little bit more healthcare investing, but generally non-technical businesses, but broadly agnostic. I mean, we back, I think, people first, ideas second, you know, market opportunity third, if I had to kind of think about, you know, the buckets that we screen for. You know, I think we tend to be pretty concentrated. We don't invest that much. We make 5 or 6 investments a year. $500,000 to $1 million checks, lead, co-lead. Yeah, that's kind of the broad.
So, just to set a little bit of a context, let's talk about the recent history. How many deals did you do last year versus this year? And just to put those in perspective, do you have a sense of, by the way, if anybody needs a chair, feel free to grab from inside and pull a chair in. Or, do you have a sense of what that funnel looks like? And you know, what is the top of the funnel and how many people are you meeting with? Because I want to give a little bit of a sense of, you know, was last year a super fast-paced year? Is this year more normal? Is it slow? What's kind of the difference? But also, you know, how many deals are you seeing? So, John, you want to kick us off there?
I think for us, our cadence has always been like, and this isn't exact, but a deal every like 2 months. So we'll do 15 to 18 in a fund. A fund's life or investment period is 3 years, so we do 6 a year. So from like 2017, I would say through like 20, so for 4 years, that was pretty consistent. I think we've generally been slower. So last year was actually like, we have peers that probably invested entire funds last year or, you know, got 80% invested. I think we've been a little bit slower. That period is just kind of a period of like, a bit of like just craziness, and sometimes we're extremely valuation sensitive and disciplined, and we have buckets for like pre-seed valuation, which correlates to like, you know, where you are in the company building phase, and you know, I don't think we've ever paid more than $10 million on a post-money basis for an entry check. So we've been a little bit slower, and I think today we're probably trying to keep in that broad range, but asking for a bit more. So early days for me, we could back, like, you just left your job, you're a, you know, high performing leader, or, you know, you're building something new, and you've got a deck, and I think now we're just kind of like, you know, I think I've said to a lot of founders in the past year, like, I love what you're doing, I think you're great, I think I could also wait a year, or wait 6 months, I'll have a lot more information to invest on, and I don't think the price of the round is going to change that much. So that's kind of been our feel on it. What about you?
Yeah, I think I would agree. I think for us, if I just think about the numbers, in terms of what we've invested in this year versus last year, I'd say we've done more investing this year, but with the caveat that we closed our fund in July of 21. So there's also that, like, that might be misleading, just in terms of how much we've deployed this year. I think we've enjoyed this year being able to take our time in a way that you know, we weren't with the 21 deals, and so I think for us, we average, I'd say, a deal a month and a half is what we're tracking to. But I think in terms of what, you know, what John was saying, which is a kind of waiting for more information, is where we're at as well, in terms of, you know, we have 4 or 5 deals left out of our fund one, and we're probably going to be looking at more solidly seed $500,000 in revenue type deals because we took some more pre-seed risk in 21 and a bit earlier in our fund deployment. So
That's a really interesting point, and it's something that founders don't have visibility into always, of like, where are you in your fund cycle. To tell kind of a funny story, back when I was, guys, if you need to drag in chairs from the inside, sorry. It's always tough to figure out how many people are actually going to show up depending on the RSVPs. So feel free to squish, slide next to each other on the couch. Sorry if it's a little cozy. If you take jackets and stuff like that off of seats on the couch, that'd be awesome. So back when I was at First Round Capital, we had one deal left in our second fund, and we looked back over the second fund, and we said, we're not totally sure if there's like a big winner in this fund, so we should take a little more risk on our last few deals, something that's like a little more binary. And so we were like out looking for like a riskier deal. But like the people who were pitching had no idea, right? And in fact, like if that riskier deal got done and that founder said to somebody else, "Oh, go pitch first round," the first deal of the next fund, we were not looking to take that same kind of risk, right? So you would think like, oh, well, those guys just had a prototype and didn't really have much to show in terms of traction. Like, why can't I get in? Well, it's because where we were in the fund cycle. Inside baseball behind that is the last deal in our second fund was GroupMe, and it got to a tie among the voting, and main partner of the fund was able to sort of break ties, and it was that like, hey, like we said we were going to take a little more risk, that actually pushed him to vote yes, because we thought consumer, social networking, mobile, viral, like we thought it could be like the next big thing. They did sell within the first year, so that was helpful. It wasn't WhatsApp, but it was still a pretty good deal. But the funny thing about VCs thinking about where they are in their portfolio, the reason why we said that was because we thought, oh, Fund 2 doesn't really have a big winner. Well, Roblox is in that fund. But at the time, Roblox, for like the first 5 years of its life, it just kind of and didn't really take off until much later. So it turns out we were totally wrong about whether we needed more risk in that portfolio or what the big winners are and all that. So we may think certain things about our own portfolio, and we think we have the most information about it, but it's not always the case. So where people are in their fund cycle is definitely a factor. For me, my numbers, I'm generally sort of, like John, a little more consistent sort of year to year. I do about 9 or 10 deals a year. It has been squished into, over the last couple of years. Like if I look at 20 and 21 and 22, there's a big period of time in the middle of 2020 where like nothing got done. And I was in the process of investing in a round that fell apart. I was still committed, the other investors weren't, and there was a big chunk in the middle of 2020 where we didn't really do much of anything. And then the market came back, and we, some of those deals sort of came back around, and we did a bunch of things in a row. VCs are people too, and sometimes we just have stuff going on. Like my 2021 was like, I had a baby in September of 2021, and she was a 2.5-month preemie, so I found myself in the NICU for 80 days. So you would think that means I didn't do any deals during that period of time, but actually when you're just sitting there and the baby's sleeping most of the time, like I got 3 deals done in the NICU. There was good Wi-Fi, it was quiet, like we were lucky enough to have our own room. So you kind of never know what's going on with the fund cycle and all that sort of stuff in terms of pace and timing. This year, summer was really quiet. And I actually found it to be really quiet from the pitching perspective too. Like I can't do a deal that doesn't pitch me. So I think what my theory is that a lot of VCs didn't get to take a real summer vacation to somewhere interesting over the pandemic because of travel restrictions and all that sort of stuff. This year they were like, okay, first quarter sucked, everything crashed. I'm going away, I'm gonna kick it in Fiji for a couple of months or wherever they go, and I'm just out, and I know I'm not gonna miss any deals. I know there's gonna be no promo, I know nobody else is really working either, and so they were like, for the most part, kind of out to lunch. Knowing that, a lot of founders didn't pitch. A lot of people who maybe had some flexibility or were thinking they were leaving their job at a certain time for a certain early stage deal, didn't come to market. Right? So like, it wasn't a lot for me to do if nobody was pitching. It's been really busy since after Labor Day. A lot of very high quality pitches, and what I've also found is the pitches are better, right? Because if you somehow found a way to make it work over the last couple of months, or extend your runway, or you know, really go forward in terms of getting early revenue to kind of keep you going or whatever, those companies are usually better. They've usually accomplished more. It's a little bit of survival of the fittest.
And if you look at the tech market, and you look at the job market, and you look at the macro headwinds, and you're still out there as somebody who's like, despite all this, I want to start a company, you know, it says something about you. You're not kind of like the tourist entrepreneur that's just gonna,
You feel like you
know,
have something.
yeah, I think so. I think there's something to be said, and everybody points to kind of that 08-09 period as some great companies were started then. But yeah, I think it says something about, you know, your desire to build a business. I'll ask both of you this question: how much of your deal flow is inbound versus like reaching out to the proverbial entrepreneur who's starting something new in their LinkedIn profile? For us, it's very little outreach. I could probably do more, but I'd be curious for both of you.
Yeah, I'd say 75% of our deal flow is inbound, and then maybe 25%, 20% is outbound. I think sometimes it's just hard to pick your head up, right? And I think I think we all pride ourselves on being. This is my first time meeting John, so I don't want to presume too much about it today. But I think we all care about being accessible, and so I think that is, it's great, and also I like being tactical, and so that's the kind of other side of kind of getting a lot of inundation and kind of having to sit through that. But also, you know, also having my own interests. Like I have kind of subplots or theses that I'm looking into within the future of work in FinTech that excite me, but I'm not always getting those deals since 80% of it's inbound.
Yeah, one of the things that, so I'm the same way. I get a lot of inbound, and it is really hard to pick your head up. I was just actually poking around this morning. Is it Moment, or what's the company behind the Stable Diffusion, this New York, the founder's New York based? It might be Moment. Anyway, one of the companies behind all of these AI images that are like flooding your Instagram feed and all this sort of stuff. The founder is New York based and comes out of NYU. And they just raised at something like a $500 million valuation or something like that now. And anytime something like that happens, like I hate missing New York deals, right? So I gotta go like, where would I have seen this? Like, where did this guy come from? Like, who's connected? Like, do other VCs know him and all that sort of stuff? And this founder, and clearly like AI is like super hot right now, and this is, you know, they raised a bunch of money. Started the company in 2018, was an NYU researcher. We have 4 people in common, 2 of whom are VCs. Now, I've been investing in venture in New York for like 20 years. If there are only 2 VCs that we know in common, like you don't actually know a lot of VCs. Because I know most of them because they're my peers. And there's
You probably haven't run a process.
You're
You're not out talking to people. Right. You're under the radar. That's exciting to me when
right.
I find somebody. If I'm surfing LinkedIn and I see somebody who does not have a ton of connections with me,
right.
I'm like, oh, this is not a picked over. Like this is a, you know. And I do think the best deals sometimes just come out of nowhere.
Right.
Like,
and the fund that led that seed round was Lux. And it's like completely not surprising to me that of all of the funds, Lux found this like random NYU AI researcher, like, cause that's what they do. They just hang out in those spaces with those types of people who are looking at the cutting edge and all that sort of stuff. So if you had Lux on the panel, they probably get very little inbound compared to what they do outbound, and they spend time in very like highly technical spaces and all of that sort of stuff. So yeah, most of it is tough to pick your head up. And the other thing I would say to that is, we give away money for a living. I mean, we don't give it away, we buy equity, but like it just feels like giving away.
Sometimes.
You can imagine what our inboxes are like. And so I feel really bad when I notice that somebody made an intro, or, you know, there's somebody who's been in my inbox, and I was like, just yesterday, I wrote somebody who like introed me to a founder 2 months ago. And I was just like, I know this sounds ridiculous that I'm getting back to you this late, and I'm really sorry, but it's just the amount of time I have in the day, the trying to get to as much as everything, trying to triage stuff in my inbox, like, I just didn't get to it, and I just missed it, and it happens. And you may be sitting here trying to figure out, like, what's wrong with my pitch, or like, why isn't this, I just didn't see the email. I just get a lot of emails. It's not more complicated than that. So I would encourage founders to, like, you know, never assume that somebody has seen something, has looked past something. You know, you don't, it's not a no until you get a no kind of thing.
How responsive are you both typically to cold emails? Like,
Try.
yeah, everything?
I try.
Yeah,
Actually, we try to.
yeah.
I think what there are some things where I'm very responsive if I feel like I can actually respond in a meaningful way. And for example, if somebody asks me a question that I can specifically answer, I mean, I also like engaging with good questions, right? So if you send me a thing that like feels pretty generic, or
It's not stage appropriate.
Not-
We get
not
that
stage
all the time. It's like
appropriate.
we're doing a $5 million Series A. It's like you read nothing about my firm because you completely precedes.
or if I don't
by-
understand,
Yeah.
like if I literally don't know what the thing is because you've used all sorts of flowery language to make it sound very impressive, and I'm like, I don't know what this is. I don't think this is a fit. I just like, this is not a fit. Sorry. But if you're just like, hey, saw you at that talk. You said something about this. I'm working on this. Here's a question. I'll jump on that if I see it. Question for you guys about this environment. So, John, you're solo. Evelysse, you're on a team.
Yep.
How much does that dynamic play in? Do you think that there's an element of, like, if you feel like that the team dynamic is affected by the environment? Like if John suddenly wanted to go maverick and contrarian and say, you know what, no one else is investing right now, but I'm going to put the whole fund to work in the next 3 months, it'd be a little harder to do on a team. Are you guys being more slow and careful because there's sort of more questions to answer around the room?
Mm. Yeah. I mean, and there's also the remote aspect, right? Like I'm the only person in New York City, the rest of the team's in DC. And so I think for us, the process, and we're still fine tuning the process, the handoffs and all that stuff. But I think it certainly slows down the process sometimes for good when you have multiple people involved in asking questions. I think in terms of deploying, you know, we're certainly in a place now where we're seeking to invest actively. We've been that way all year, and I think, you know, there's certainly been folks that have pulled back some, and you were talking about kind of 2020. You know, I think it's tough because my vantage point is I worked at a pension fund investing the alternatives portfolio for that pension fund. It's the Board of Ed Retirement System here in New York, and so basically from an LP perspective, right, you should be investing through a cycle, right? You should have the knowledge to invest through a cycle, and I think that's more of the stance that we've taken. Obviously, I think May and June were really frothy in terms of like the correction or lack thereof from a founder perspective as it relates to valuations. And I think we're still working through that. I don't know how that would be my question to y'all is kind of working through the valuation reset or the expectation reset. But we've been, I was thinking as you said, you were talking about June, or the summer rather, and we invested in a few companies over the summer, and kind of prided ourselves in doing work the whole summer, and then I was like, when fall hit, I was like,
So
Lord.
you weren't just playing softball the whole summer?
No, I was not. I was not. That's why I came late. To somebody who didn't see OA like in that way, to be investing and trying to project out and be like, well, what is going to happen here with this company for what reason, right? And that Roblox example was comforting, and as was the group me one as well, because we don't really know. We don't know.
And I think for pre-seed, where we invest, it's, what was the price for a company for two people starting a business 10 years ago? It's
2.8.
Yeah,
That was the group me pre-seed.
That was legit. Yeah, I mean that was very.
It was 850K on 2.8.
Oh wow.
So,
And that was a normal deal. That was not like we were squeezing them. It was two
So
people
it's,
on prototype.
I guess it's gone up, but in that time period, the ability to launch something new has gotten easier. There's more exit possibilities, more liquidity, so you could argue that the valuations have come up commensurate with the opportunities. But it hasn't changed that much at pre-seed and seed. I think I look out to the later stages of the market, and there's a lot of times the difference in a Series B might be 50 million, something that was priced at 50 is now 150. So that's it. You could be an order of you can be 3x wrong or 200% wrong if you price that. We can't be that wrong. Like if from where we invest to an eventual outcome, you're just not going to be. I mean, you could go to zero, but the asymmetry, I think, of where we invest is one of the things that attracts me to pre-seed investing, seed investing, and I think, so I think you just have to be consistent in your pace of deployment.
I think you brought up something about expectations and resetting of expectations. One thing that I've consistently tried to do is try to be early to stuff, but also early to making decisions and to putting out term sheets, right? And so I've found that if I can get a term sheet out early, founders hate fundraising. And my goal on pricing is to give you a price that is less than what you wanted, but doesn't necessarily make you think that I'm an asshole. There's a balance there, right? It's like, well, I was kind of hoping for a little more. I was like, well, I'm your only bid. And so, like, do you want to walk or do you want to take it? And they're like, okay, we'll take it. So like slight uncomfortability, that is like
and I think
the right
speed
pricing.
to market is if we feel like if I like something, I assume everybody's gonna like it. That's not always the case, but we'll often just do a safe if it means if I can say to a founder, I love this. We can sign a safe tomorrow, and you will have money in your bank by Friday. Like we've won a couple deals by a founder just not wanting to, go out and run a long, drawn-out process. So I think.
And by the way, I think almost every fund can tell you about that. And so when I'm invested in a company and that company is fundraising, I am always the first one to point out that like the longer a process goes, the less likely somebody is going to be to invest. I mean, when you're third, fourth, fifth meeting in and they're not sort of coming to a term sheet or say they're working on a term sheet, I just don't think it's going to happen because all of these funds have instances where such and such a founder who built something before comes in and you know it's going to be a hot round. If you don't say yes this week, you're definitely not going to be in. I mean, actually a couple weeks ago, I saw a deal that was sent to me by another fund. They knew the founder. It was basically on a PowerPoint, but they had a long relationship with the founder. Interesting space, probably priced a little higher than I would have liked, but they offered to show me the deal. I met with the founder on like a Wednesday or Thursday. Originally I was excited, and then my excitement kind of waned over the weekend. By the time Sunday came around, I was like, I don't know about these things. I might not be there on this, and I reached out to the founder on Monday to schedule a second meeting to maybe give them the opportunity to like talk me back into it. The round was closed. Like the round, like it filled, right? And so it's interesting that a lot of founders come back to me and say, well, you know, a lot of these VCs are taking a long time, market's slow and whatever. I was like, actually for certain deals, the market is like, this thing started showing on Wednesday and was done by the next Monday. So for the right deals, they are going. I mean, maybe there's less of that happening, but it certainly still does happen for sure. The other thing based on expectations too is I personally find that there's a little bit of a signal for founders who come in that are way out of market, way, you know, their pricing
There are people that are
expectations.
still living in 2021 for sure.
Right. Or they say, oh, you know, I talked to a bunch of other founders and they said your term sheet was like really low. And I was like, okay, but it's still the only one you have. So it's not like the market is telling me that I'm wrong on this, and you can go feel free to talk to other people. But, you know, you never know the circumstances of which somebody else raised, when they raised, the timing, the relationship with the people they had, you know, who wrote the check. I think it's like, there's one market, it's the market for your company today, in this environment, with the set of people you're talking to. It's very hard to compare rounds to each other.
Great.
A question I want to ask both of you about, you know, sort of process and standing out, and then I also want to talk a little bit broader about like next year and timing. So, and actually maybe it'd be helpful to get some context to the folks in the room. Who here is an entrepreneur? Okay, great. Who here already has a pitch deck that they've shown somebody? Okay, most of the folks. Who here has taken at least one investor meeting? A little less, all right. And who basically is planning to start this process in like January? Okay, cool. So it's a mix of people in process versus people starting. For some of the earlier stage deals, a lot of the founders here are probably wondering like, how do I put my best foot forward? You know, I'm super early stage. There's a lot of things I haven't figured out about my company. I obviously don't have everything figured out. I may be pre-revenue, I may be pre-product. What are some examples of the way that founders have like stood out to you, not just in like what they send you, but like how they run their process and how they approach you?
I think for me, one of the things that I'm always impressed by, there are certain founders that everything they do, you need money to run a business, don't get me wrong, but there are certain founders that you leave a conversation feeling they're gonna move. With or without you, they are working, they are doing things in the background to start. We're talking to, you know, we're building the product, we're talking to potential customers, we're, you know, and it's more, you know, almost a vibe that's created during a process of like, this thing's moving with or without you. And then there are instances sometimes where you feel like, this is just, we need this amount of money and I'm not gonna do anything until I get this money. And it's kind of like, so I, you know, for me, I used to, when I started doing this 6-7 years ago, it used to be sometimes a process could run like 6 to 8 weeks, like that's just not the case anymore. And I used to always just track kind of like from conversation, we'd have 5 conversations maybe, what's happened from conversation to conversation. So conversation 1, this is where you were, you sent me an update.
Like,
you
are you
did-
still running the company while they...
Well, right, yeah, and you know, this exciting thing happened, and you know, and those are the ones that I think like you want to build energy and excitement during your process. You don't want an investor to feel like, you know, you could move on to the next thing if you don't get this funding, and everything is riding on this funding, you know, on the fundraise. So that's one for me always, is just like those, when you have a very short history with somebody, you maybe have only known them for a couple weeks, every interaction is being measured, and you know, the time between those interactions are opportunities to prove that, you know, you're moving, you're doing this thing, and you know, the train's gonna leave the station with or without this investor. So that's one thing that we think about, or I think about a lot.
Yeah, that's a really great question. I haven't thought about great processes, or kind of taking a step back to be like, wow, I really like that about your process. I think yeah, I mean, I think some great things I've seen done. I think it's always great, and these 2 guys are so GP, so maybe they're less sensitive to it, but whenever the like memo is basically written, that's very helpful. Just you know, and that's like post data room access generally, but I think there have been a few companies we've underwritten that had memos completely written, kind of problem statements, solutions, all of that, very streamlined.
Were they essentially wrote them?
Yes,
Okay.
basically, which, I mean, that's a really great way to ingratiate yourself with anyone that's very junior. So yeah, but I think that is really, that's really helpful. I've seen that. I think the other, and I mentioned this yesterday, I was on a panel yesterday and mentioned this, but it was probably one of my most diligent founders was doing reference checks on us, which you all should do, and did some blind ones. Like, he didn't, not ones that we provided to him, just that's how his network is, that's how strong his network is. But he even mentioned to me actually that he did the same thing with the co-lead on this deal, and didn't get as good feedback on them, and actually share that with the GP, which was really interesting. And I love this founder. I think he's great. That was kind of to your point. I think that was a flex, 100% a flex on his part. It was a competitive deal. But I think really what that felt like to me was it didn't feel like, and I think this goes for a process in general, is like, you don't need to like bash someone over the head with competing, you know, term sheets. I got this term, you know, you want to inform folks that seem like they might be interested. There's a way to do it that's even keeled, I guess.
Yeah, like a faux, like, creating false urgency is like, we've seen it all. You know when something's real and when something's not, and I just don't know that it really works. Right. It only works when it's real, and I think 9 out of 10 times we can sniff out when it's not.
Yeah.
Like, I think this both points to like not treating capital as purely transactional. I mean, these are humans that are going to be involved in your company. I just actually went through a thing where Meta founder, mid-process, got into Y Combinator, and Y Combinator is very big on like, you're not supposed to raise before demo day because it benefits them to like have the fundraising happen all in one gauntlet kind of thing. And like, I was in the middle of the process, and so in my mind, I think maybe I should get a phone call and just be like, hey, thanks for your time, here's what we're gonna do. And actually it was a deal that like I wanted to do, and I said, you know what, like, I've done enough work. I sent this founder a signed safe. And I was like, if you wanna take money right now, it's not enough money to like ruin your, Y Combinator deal, like why not take it? And the founder's response was, I'm sorry, we're just not talking to VCs until the end of demo day. And I was like, yeah, but I like spent some time here, and I also just actually offered you a safe, so I don't know, the stock market could go down like 30% tomorrow, and then you kind of wish you would have had that safe. But I just felt like I was being grouped in on like, I need some capital, you're just in the capital category, I'm not going to treat you like a human being, I'm gonna herd you into the Y Combinator gauntlet later. And I was like, you know what, like if you can't get on the phone with me for 10 minutes and just talk out sort of the explanation for what you're doing, like I'm not sure I really want to work with you. And there is a balance, right? Because it is a transaction, but to the point of like the fake FOMO thing, best advice I've ever heard actually came from a founder who basically said, what I tell investors is that I'm going to spend X amount of time with each investor. So like, you can't always line everybody up, but you can say, hey, just so you know, I am planning to spend about 3 weeks with each investor. Happy to ask whatever questions, however much time you need, and my hope is that you can come to a decision within 3 weeks. Like, can you do that? And so they weren't saying, I'm going to be done with this round in 3 weeks. They're basically saying, I'm going to be done with you in 3 weeks, which is like completely fair. They're like, I'm giving you an opportunity to look, but we're not going to do this forever. If you need more, let me know, but like this is the time, and then I'm gonna move on. I'm just gonna assume that you're not getting there on this if you don't tell me you need more than 3 weeks. And I think it's a nice way to kind of move the process along without faking that there's like some round that's gonna close when it's really not.
Yeah.
What are you guys telling founders who, there may be some folks who have some money but would like more, in terms of how they should set their goals and expectations where, they have some limited pool of capital, it would be nice to have more, but they can get something done over the next 6 months, and then they're gonna go out and like what should their fundraising strategy be now, and what should they be optimizing for if they have a finite pool of capital, maybe some friends and family, maybe some angels?
And we advise our existing portfolio on this too, as some of them look to fundraise. And for me, I think, and I guess this is kind of a fun, like just kind of when to go out to market as well. I've been advising folks, obviously you can have conversations now, but when you hit that 12-month mark in terms of runway, you should definitely be running a process is kind of what we've been advising folks. And so part of that means segmenting, in general, I just like segmenting kind of different scenarios in terms of fundraising, like what is your bare minimum that you need to fundraise to hit whatever metrics you're trying to reach, and then kind of what would be the optimal scenario, what would be kind of excess or oversubscribed round, and where would that get you? I think, that's what we've been doing. Our portfolio companies have like upwards of 18 months of runway at this point. We prefer that to be closer to 24, honestly, just because we don't know what's going to happen in the next 2 years.
But what if I just have like friends and family money, and I'm not quite a venture portfolio company yet, but I've raised a little bit of money that like maybe I could stretch out to like 6 months, and but I'm really trying to like set something up to get other investors interested.
Mm-hmm.
Should I be like revenue focused? Should I be double down on just meeting more VCs?
Mm-hmm.
Like, any advice there?
I think you should be strategic about who you're meeting with if that's the case, because you do want to prove, you want to be choosy, but you're still trying to prove something out. So kind of making sure you have an idea of what you're aiming what you're aiming towards in that time span, and then being able to check in. I think John, you might have mentioned like kind of checking in at different points. I like when founders do that too when we're in conversation with them. Okay, you said this, you were going to get feedback from a prospective customer on this in 4 or 5 days. Let us know what happened there. Kind of keeping folks abreast of what you're working on and any pivots you might be making is what I would say.
Yeah, I mean, I think if you have a small amount of money that you've raised from friends and family, you have to think about what is like your minimum viable, like fundable, like what do you need to look like to get an investor to invest? And I think I always say to people, you know, whether it's a pre-seed round or a seed round or a Series A, paint me a picture of what you think this business, like what is the narrative when you're going out for your next round of funding and how do you get there? So if it's $300,000 raised, like what can that get you your first customers? Can it get you just a fully baked product? People invest on team and ideas all the time. So, you know, it depends on, you know, the category you're in, but it really is like, what is that, like what is the biggest bang for my buck? What can I do with this capital, and is it fundable? And sometimes you just have to raise $300K and get to a next milestone and cobble on. I mean, that's how I started in this business. It was cobbling as an investor, cobbling together like $25,000 checks to do make my first investment, and then that first investment, you know, gives me the license to go back to more people to do the next one. And I think it's no different for a founder. Just tranche it and try to hit a milestone, raise a little bit more, and yeah, I mean, I've seen it.
My first fund took 20 months to raise. I mean, I was almost like 2/3 of the way through the fund by the time the last check came in.
Yeah, I mean, not dissimilar. Like it took a long time. Yeah.
You made a comment about things happening all the time, and one thing I always sort of remind founders, yes, it is true that there are lots of companies that get funded on PowerPoint, right? But it is also true that as a percentage of all the companies pitching, it's very few.
Yeah.
Right? So like I could say, yeah, 50% of my deals were pre-launch, but 99% of the pre-launch deals that pitch me, I say no to. Right? So it's like, yeah, this happens all the time.
But it actually doesn't happen that
But
much.
it rarely
Yeah.
happens, right? It's like I just commented, somebody wrote on LinkedIn something about like what's happening in VC now, and he's like, so many VCs are non-investing. I was like, well, as a percentage of all my time, I'm not investing most of the time, right? Like if I only write 8 to 10 checks a year, and I see 2,000 things, most of the time I am in a stage of default, no, I'm not investing. But some other VC might say, oh, 10 deals a year, that's a lot of deals, right? So you keep in mind that like most people who attempt to raise aren't necessarily successful. This idea you have now may not be the idea. I mean, it's funny, the founder of Feather, the furniture rental company, when I was asking him like who raised his first round, he said, oh, funny enough, I pitched you on 2 previous ideas. And I was like, well, and he's like, they were so bad, right? And Feather has been like raised a bunch of money, and it's gotten lots of traction, and Jay, that's his name. And I said, well, why didn't you pitch me on this one? He said, well, I just didn't think you'd take me seriously after the first 2 were so bad. But I'm sure at the time he thought like those were really the things. And here he is, 3rd time around, raising from, you know, Kleiner and Sequoia and whoever, but it took him quite a few iterations. Before we get into more questions, I do want to take some audience questions, but I also want to pause a bit to let everybody know where they are. This is Primary, it's not Primary Ventures, it's Primary Co-working. And this is there's 2 floors, 8th floor and 3rd floor. They have graciously given the space to us, probably not expected us to get so many RSVPs, so next time we'll see if we can, you know, open these doors. But I work out of here, I'm here 1 or 2 days a week. I really like working in the financial district because it's like just super convenient public transportation wise to most places. in and around the city. It's a wellness focused space. So they have like yoga classes, and there's a Peloton here, and showers back here. I'm really glad no one just like walked out and shower over here. But it's nice something like over the summer. I actually bring my infant here. Sometimes we have a pack and play in our office, and so I'll run her in. It's like 4 miles door to door, and use the showers here. So thank you, Primary, for hosting us in the space. Do we have audience questions? Maybe I'll take like 4, and then I have some questions too. So we'll go 1, 2, 3, then 4.
Yeah, I had a question regarding how would you feel, or how have you felt in the past about solo entrepreneurs that have an idea and a concept, but they might not have a CTO, but you might like their idea and their resume and experience. Have you ever invested in someone like that, and why?
We've definitely done it. I think increasingly our preference is becoming for the full team to be in place so that we can, I mean, I guess there's 2 schools of thought. We've definitely had situations where we've invested and then helped source that person. So yeah, we're not opposed to it, but I think slight preference towards like the team being set.
But you have helped in the past, like investing and going, oh, I know a CTO.
For sure.
I think the one thing I would say is like, it is totally reasonable for you to say, I have no money to pay this person right now, so they can't be on the team. But money isn't necessary to identify the person, right? Like you should do your homework and source people. If somebody came into a meeting and said, please fund this company so I can quit my full-time job at wherever, I am totally engaged and willing to be part of the team once they raise, that person's as good as being on the team. So I think like, if there's a key person, right, there's some products where it's like you're doing some direct-to-consumer thing and like you're just gonna be on Shopify or whatever, and you don't really need like a co-founding CTO for it. But if it's like, I don't know, the next great, Apple for whatever bathroom scales or some shit. I guess that's why there's but like you need somebody who's done some physical design, and that DNA kind of needs to be on the team. So if you don't know anybody in that space, or you haven't identified them, like it's kind of hard to bet on you if you're just like, I think there should be an Apple for bathroom scales, and like you haven't taken the time.
Yeah, if it's a mission critical component, like I'm building not piecing together a bunch of APIs to build software, but I'm building unique proprietary software, and you don't have a co-founder that's an engineer. It's like, well, that's your core problem. You also might not be thinking about the risks of this business in the right way, which I think would raise questions for me.
Or somebody else back there? I think there were 3 hands. Okay.
My question is from the investor standpoint, kind of like what you're seeing structuring at the earlier stages, just given that there's a repricing of risk across all asset classes. And with later stage companies, we're seeing like an uptick in structured rounds, like liquidation preferences. I'm wondering how the group up here looks at underwriting at the earlier stage.
We generally haven't changed that much. I mean, I would say we used to do like 90% like safes or convertible notes. We're investing out of a slightly larger fund, so maybe now we're pricing things a little bit more and having a 1x liquidation preference. But the reality is it doesn't look that different than the rights assigned to you if you were a safe holder. And then valuation, but no structure on an early stage deal, like nothing, predatory or, I mean, we'll try to, we don't want to overpay for things, and I think to Charlie's point, if I'm giving you a term sheet and you're just asking me for a higher price because you think you deserve a higher price, I'm not going to negotiate against myself. Like, if you're telling me that the market is, I've got 3 term sheets and the highest one is going to win, then okay, sure, we'll pay up a little bit, but yeah.
Most of the structuring I've actually seen is comes from internal investors, where somebody's like, listen, I wasn't planning on putting more money into this thing, but I feel like there's something here, just not at this price. So go raise from elsewhere. But if you have to come to me, I want to own more of this company, because I wasn't really budgeting on putting more money into this. So I've seen a couple of portfolio companies have some, not a ton of liquidation preference, mostly because you don't want those staying, and so they tend to like mess up later rounds, and they need to expire. Sometimes that happens if you think you could sell the company at some point in the next 12 months, and so they're taking on extra risk. But where I actually see it a lot is in uncertain raises, where somebody's like, listen, I need $5 million to get to the next thing, but 2 to 3 million would also be okay. The person who, I mean, I just literally saw this term sheet that was like, look, it's 5 on 20 if we raise the 5, but if you only raise 2, it's 2 on 13, because it's just a different risk profile. Like there's just less money to go around, you can do less things, and they're focused on ownership percentage, so they didn't want to be in a deal where they essentially led a $2 million round on 20. They would understand why you didn't want to raise 5 on 13, so it's like, look, depending on how much you raise, it's like what the price of this thing is. You have 3 months or 4 months or 5 months to raise it, otherwise it ratchets back down to the next number. But most of the deals I've seen is like from internal, just paring down their own fundraising risk. And then another deal where like it was supposed to be a larger round, somebody backed out, and then the existings were like, we're in half a round, and you know, we should reprice this thing. So that's where I see it most.
Thank you.
Somebody, yeah.
First off, thank you so much for sharing that story about your experience trying to invest in that Y Combinator.
No problem. I mean, maybe that turned out to be the biggest mistake I've ever made, and I just should have played nice and hung out towards the end. But
I appreciate the candor. Not a lot of VCs share those stories. But on the flip side, as a founder as well, I've had situations where VCs have committed and then backed out, even this year. And so, with that being said, let's say
term sheets or verbals?
Verbals and
Okay.
term sheet. So how do you navigate that process of then trying to maybe find a new lead for your round? Any counsel there?
First off, I hate that happened to you. Like that's just like poor behavior and just not a great thing for anybody to do.
Assuming nothing changed.
Yeah, assuming that if they just changed their mind or they saw the S&P was down 4% one day and are like, you know what, I don't want to do this. It's like that's how do you navigate that? I guess kind of back to just back to the grind.
Are you worried about signaling that it like looks
Oh,
bad, the
yeah.
round fell apart?
Not even that,
Okay.
right? I mean, the other investors are still committed to the round. It's just.
Are they committed based on a lead? Like, was this the lead and it's like we'll invest but pending a lead kind of?
No.
Or?
It's more of a thing of like you have, $1 million that's missing from your round. Like how do you go about then trying to find a new lead, or do you just go back to the drawing board and trying to find angels? Like what are your thoughts?
I think you probably gotta try to find a new lead and be like, listen, we had a commitment. If I fell through, didn't work out, in the long run we think it's the right thing for the business, we'd love to re-engage with you, or new outreach. I mean, I don't know.
We had that happen with one of our portfolio companies for a follow-on round, and obviously, this is our case, it might not be yours, but kind of basically there was an inside round, and then one of the existings kind of led the subsequent round. But I think if it's any consolation, everyone else around the table takes note of who did that, and that has impacted our relationship with that firm. So, like John said, so sorry that happened to you, and also I think figuring out who around the table can help you kind of fill in that gap, and or kind of understanding, was it a strategic gap, or like is it a strategic gap now? Is it like a domain expert? Is there a domain expertise now lacking? Kind of like what were they bringing that you need to kind of fill now? Is what I would say too.
I just had a fund that bailed on the deal in March of 2020, asked me for an intro to one of my LPs. And I was stunned. I was like, are you serious? Like, you crushed this company's round in the middle of it, in the middle of the worst period of time. Like, how do you, I don't really remember it being that way. No, I remember it being that way. The founder sure as hell remember it.
It's almost like that movie where, like, I forget where, there's a tsunami and, like, one of the parents, like, runs from his family, but everybody survives, and they're, like, trying to figure out how to, like, reconcile this. It's like, business will go on. You will meet these people again. You will come across them again. It's like, yeah, so, it's a weird example. I don't know.
The other thing I would say in that situation, though, is I think it's important to be transparent and keep the trust of the existings, right? Because there's a reality to, like, let's say, without going too deep into your particular situation, let's say you're like trying to raise $2 million, right? And like 2 million, it's like 2 million or bust. If you don't get 2 million, there's really nothing to be done here, and you like lost half the round, right? I do think you really need to be careful about like whether or not you want to close on the other $1 million if you're pretty certain that like the other $1 million doesn't really lead you anywhere, and you kind of need 2 million. So like you got to be careful about those like half rounds or rounds that are just like raise to raise, where you're just like, oh, I'll take 250 and that'll give me more time to get other investors interested. Like if you can't actually accomplish something on the money that you've raised, you really have to think about whether or not you want to spend other people's capital that way. But if you say, look, I know we lost these guys. I appreciate the fact that everybody else is still in. I have a call. Everybody is invited to this call. I've worked through the numbers. I've reset our goals. Like, here's where I think we can get to. I do think this is a fundable place. Would love to get the feedback. If anybody, has comments or whatever, I would appreciate that. Right? I mean, I just went through one of my portfolio companies was looking for some additional capital, and I don't have a very big fund, so I don't do a ton of follow-on. But my first question was like, if you don't get this whole thing, like, where are you? And he wrote me this whole thing about like, we're getting to break even based on what we raised, and here's what it means if it's 2 million, here's what it means if it's 4, here's what it means if it's 5, and at least he was like thoughtful about like, this is the plan based on all sorts of money, because I also think that like, look, a lot of these investors in other things, they see what's happening in the world. They don't expect you to work miracles. They just don't expect you to be on top of it. To just be like, you're conscious of the environment, you're taking appropriate steps, and they feel like, hey, listen, I wish we had that $1 million. We don't. At least you have a plan to lead us to, some brighter future, and I think that's important. I have a question for the panel before we dive in, and maybe we'll go another 10 minutes, so we'll get a couple of other audience questions as well. When you think about the pitches and plans, how much do you think about next round investors and what the environment is for, if you're doing a pre-seed round seed, or if you're doing seed round sort of Series A, and your expectations for like, how should founders be thinking about that next round? You mentioned 18 months of runway, whether it's like runway or goals, because I know it's like the later stage guys that are feeling the most pain right now, that they're over their skis on deals. So like, do you think about, can somebody else fund this down the line, or who's going to invest in this, or do I care if like, you talk to somebody at Excel and they send you the deal, or they're interested, like how much does that play a factor?
Yeah, I say for us, and it plays a fairly large factor into how we think about underwriting. I think we also just try and be disciplined about underwriting. Like John mentioned earlier, we generally think about kind of like $20-25 million valuation caps for what we're writing.
But these are round sizes of how much?
anywhere from $3 to $7 million. So yeah, and obviously
Before everybody walks out of here thinking that pre-seed rounds are $25 million.
That's right. No, I think for pre-seed, similar to John, we're not doing above 10. Like we're not really doing that. But it's also great. Like we certainly think about it. It's great when the founder thinks about it. We had a founder in a competitive deal that we wound up winning. We increased the valuation based off of the kind of competing deals, but he even said himself, some of those deals were out of whack. $12 million for a pre-seed deal, that was a great indicator too, because you should be thinking about it. We're thinking about it, but you should also be thinking about it in terms of what you'll be able to raise at for subsequent rounds. And that also relates to metrics in terms of growth rates and kind of revenue numbers as well. I love scenario analyses, kind of like Charlie was saying. What does 1 million get you? What does 2 million get you? What does 3 million get you? In terms of whatever it is you're trying to drive, and then also thinking about subsequent fundraisers for sure. We think about all that. All that's important, and I think you all should be thinking about that.
One comment I realized I didn't add, like what stands out in the process, something that I thought of, is flexibility in thinking about the round.
Yeah.
To be able to have a back and forth. I can't tell you how many rounds where I've said like, actually I think you should raise a little more, and when a founder comes back, it's like, no. This is what we're raising now. We don't want to waste a bunch of time on fundraising. They're like inflexible in even thinking about it. It's like the next 8 years of your life is going to have to be flexible and pivoting and moving around. And it's like you can't even do this in a thought exercise now. It just like really doesn't sink well.
Yeah, I think we try. Inevitably you're led to how many months of runway do you have? I think. I always find a company raises 2 million. How much runway do you have? 18 to 24 months. They raise 5 million. How much runway do you have? 18 to 24 months. It's like, whatever you raise, it feels like the majority of founders will figure out a way to burn that in 18 to 24 months. It's just my experience, and we definitely try to steer people more towards metrics and say what does your next investor, what does the business need to look like to get funding? And if it can happen in 6 months or 12 months, great. I mean, that doesn't mean we have to burn the money in those 6 months, but again, what is that minimum fundable business? So yeah, it's more if you need 1,000 paying users or 5 SMB, customers paying $100,000 each. Let's figure out how we can get that, and then let's work backwards and say, okay, we can go out to market. Because I don't know, I think it's scary when you're just driving, towards an existential time in the future where you may not exist if you can't raise. So let's raise on, and let's spend with a business metric in mind. I
think to that point too. You want to understand why you're driving to that metric, and I really can't emphasize enough. Don't just repeat what you heard in some, founder chat or whatever. It's like, oh well, we're trying to get to 100K in MRR because that's what you need for a Series A. Well, did you just hear that?
Right.
Do you have data? Did you actually talk to the enterprise person at, in your VC, and they said that the last 3 deals they started talking when they were at 90K in MRR? Or is it a little deeper than that? Most of the time I find that these metrics are proxies for certain things that are unlocked, right? It just so happens to be that I find that most of the companies who hit 100K in MRR have figured out the sales economics of an individual salesperson, have an actual funnel and flow and metrics, but they're the maturity of their sales process is such that they've figured a lot of things out and can answer the question of what would I do if I raised $10 to $20 million and how would I grow this business? Whereas before that, they don't really have good answers to that. So it's not the 100K a month that is the reason why Excel's gonna lead your Series A. It's because in the meeting, they're like, what would you do with $20 million? You have great answers, and you can talk about, you know, your sales efficacy and your cost of customer acquisition and all of that.
Yeah, we fund, I think, particularly Charlie and I at our stage, fund uncertainty. We want you to take capital and build certainty so that your next investor who's not willing to take that uncertainty risk, you know, can look at your business as a machine that is a little bit more predictable, repeatable, and scalable, I think.
Cool. So last 2 questions before I can get these guys out of here and I need to go home and take over for childcare. So 1, 2.
Yeah, so my question, I guess, in regards to funding uncertainty, what signals are you looking for when a company is looking to raise a pre-seed round and they have a product but it's not on track? What's tipping you to actually raise a check?
So I probably repeat this in every panel, so I apologize if you've seen me say this on previous panels, but like, you don't get a round as a reward for what you've done in the past. You are selling tickets to the future, right? So if you have traction, like, that's great, maybe, it's probably not gonna be that much. There's very few deals where I've said like, oh my God, this is so much traction, I have to do this deal, even though I don't really understand about the market, or, you know, I don't think the founder's that great, where it's like traction led, especially at my stage. I think it's more like does the traction de-risk something? And oftentimes it doesn't, right? Where somebody says, you know, somebody who maybe has a big social following or is good at that engineering and said, oh, I got such and such number of people to sign up for the beta, but like no one's paying for anything, and it doesn't really prove much of anything, right? Because maybe my question is, will people pay for this? So you have 10,000 users, but like no one's paying, and so to me, you might as well have no users because the big risk is still there. So it really depends on the company. I would push a founder to basically ask the VCs, like, what do you see as the risk? Because some VCs are like, no, it's too early. Push them. Like, well, what do you think I'm not going to be able to accomplish? Or what's your big concern? Like, what do you, do you think people won't pay? Do you think that this isn't needed? Do you think that my competition will catch up to me? Like, what is it about the too early part? And make sure you know that and you try and do things to potentially de-risk that.
Yeah, I mean, I think you hit on most of it. I think, I think we're always trying to de-risk it. There's always, again, for my stage, Charlie's stage, and I think even Marlene's invests, there's always going to be some risk, and we're just trying to like gauge upside, downside scenarios.
And there was another question back to you.
So I appreciate how all of you have done a lot of investing in diversity and inclusion and risks that other people won't take and helping to de-risk that for future market investment. But I was recently at Forbes Iconoclast, right? So it's 250 world leaders in the room, maybe 10% are women, almost no people of color. Ray Dalio is the keynote, and he talks about how we're heading to a recession, and what keeps him optimistic is man's capacity for innovation, which the word choice is not lost on most of the people in that room, right? When we look at the NASDAQ today versus the NASDAQ 50 years ago, entrepreneurship has one of the best capacities for changing the makeup of the demographics of who builds and scales technologies that impact these communities. But when I hear you guys talk about FOMO, it internally rubs up against something that I see a lot of founders that are not intrinsically from these communities rub up against, which is that we like to build sustainably and slowly and to test and make sure that we're not taking risks that harm communities and populations we're serving. And so we're less likely to do a deal in 36 hours with as many people as possible, and whoever just is the highest bidder is going to get in. And so how do we balance that like need for, de-risking and FOMO?
Yeah, I think de-risking can mean a lot of things. Like I think, and I would say, first of all, I appreciate your question. Part of our thesis is to invest in diverse founders. Like that is just part of what we do at Zeal. And so what that often means and looks like is doing more with less, like 100% of the time. And I'm not saying that's okay. I'm just saying that the resourcefulness that is required of diverse people in this space is different. And even the term, the valuation, that's why leading rounds is really important to us, because the discrepancies in valuation for diverse founders versus cis straight white male founders is very, very, very different. I think you can create a process that fits whatever you want to solve. It fits. I really like Charlie's example actually of the 3 weeks. You have 3 weeks as investors. I'm gonna assume if you're setting the boundaries of yourself preemptively. So I think you can create whatever kind of a process you want that solves for the things that you're trying to preserve. Like that's what I would say. I've seen founders do this. I have founders I love dearly that have raised less or solving for dilution, and people tell them they're crazy, and they're like, no, this is my blood, sweat, and tears. And again, it's a black male founder, like he, that for him, it's like ownership, my blood, sweat, and tears. I want to solve for this. That's okay, but you do need a level of flexibility around something else. Like that might mean for him, he needs to go back to market in 12 months because he's raising $750K and needs to prove other things out in that timeline. So I hear what you're saying, and I think that there are ways to do that that fit you. Like that's on you to carve out. Like this is what I'm gonna do, and this is what I'm not gonna do.
I had a really interesting exchange by email with somebody yesterday who pitched me and said, I know your criteria is you only fund companies that have yet to raise $750K. My company has raised $762,000, so I didn't know it was fit. You can guess the gender of the person who sent that, and it was not a guy.
Why would you able to guess the gender of that?
Because guys don't do that.
Yeah.
Because guys would never. Because I said, obviously I'm generalizing, right? But I literally sent the founder the HBS article, the Harvard Business Review article of how guys will apply to a job that they only fit 60% of the criteria of the job, and women won't apply unless they fit 100% of the criteria of the job. And I said this, and I said, hey, like, I'm glad you're paying attention to who you're pitching, but you're selling a stake in your company. Why would you ask me if you don't fit for 12 fucking grand? I mean, it's not like they've raised $3 million and then they for 12 grand, right?
I think that person is being mindful.
Right. And this is literally the conversation I had with the founder, right? And I said, look, I just want to point out that you're basically asking if you should take yourself out of a very competitive process at the beginning, and like this I think something like almost 40% of the teams that I've backed have female founders. So and I see this a lot, and I think it affects the outcomes. I think there's a lot of stuff on our side. I don't need to have this whole conversation in the last 2 minutes. But what the founder said is like, hey, I'm being thoughtful here. I want to make sure like I don't waste my time, all this sort of stuff. And I do think there's balance. And what I said to him was like, thoughtfulness and all of that is great for certain things, right? It's great if you're selling insurance. It's great if you're potentially doing a private equity deal in which there's like not as much upside because it's a mature company and you just want to like avoid the downside, right? Like a big LBO fund can't have bankruptcies in it because like they don't, their big wins are 4x, not 30x, right? You're raising a seed round or a pre-seed round. It's growth capital, right? Like you do have to break a few things on the margin and be a little more flexible. And so the kinds of risks that you will need to take as a founder involve convincing me to invest in this company, making me think it's the most awesome thing since sliced bread, and then, by the way, being silent on the $762K that you raised and letting me figure out, for 12K, I seriously doubt I'm gonna be like, what the fuck? Like, you raised 12K more than my limit. I'm totally pulling out of this deal after I already got there on this. Like, you should break those eggs, right? Because you're gonna have to break more than those types of eggs as an early stage founder that doesn't have a lot of, and I'll tell you, it's a signaling thing, and it is, and I can't help but escape the bias of my brain immediately goes to, is this founder going to be able to take the risks necessarily to do an early stage deal? And like, that's my bias, right? And I have tried to work through and identify those biases, but there's a reality. It's like, is this bias tied to the way that this person has been socialized or innately thinks? Or is it really true that actually, like, this founder's just not going to take enough risks if they can't take the risk of, like, being slightly over my cap? Like, I don't know the right answer, but I will say that, like, when you're pitching to, 90% guys that look like me and John, no offense to John. John's better than I am.
Slightly more hair, but
slightly. I have less hair than I thought I did, actually. There was a time period where I was like, oh, no, I'm like really bald now. I'm not just shaving my head. That's your audience, right? Like it or not. And so there's going to be things on the margin whereby you know your audience and you know how they're thinking, and the context of like they're trying to build a big company, right? And you're not telling them. This happens, by the way, a lot of times in pitching potential versus likelihood. Is it possible that this could be $1 billion business? Is it possible that you could be at $150 million in 7 years? You need to be able to say yes. You need to be able to pitch that. Is it likely? No. It is statistically likely that you're going to go out of business, but that's not what you pitch in the meeting, right? And there's a big difference between how genders, races, all of that sort of stuff pitch, and the reality is, I think people on our side are looking for potential. How big could this be? We know the reality of what it's likely to be. You don't need to tell us that. But when you do tell us that, I think it just affects the enthusiasm level for the person trying to buy high-risk equity. It's hard to get out of that thinking.
One more comment just on the FOMO question, because I think it's a good point. I think investors generally find comfort in consensus. This person came from this pedigree, or this person, did this. Everybody agrees that this is going to be a big idea. But the reality is, some of the best investments that I've made are, I've been sitting on an island, sitting on an island for 2 years. Asymmetry comes from those types of opportunities, and I think you almost need to take solace as a founder if you're getting the rejection sometimes. It's not always obvious, and sometimes, as an investor, you do well. If you're consensus and you're right, you'll do fine. You could probably have a career, you won't get fired, but the outsized opportunities are the ones where you're non-consensus and right. And I think that's, so many companies seem like you said, Looks, did nothing for 5 years.
Pedal 6 pre, there's 21 people on the pre-seed cap table. Nobody else wanted to do it. The founder had to take 80 meetings. The company has like 200 people and it's worth $800 million now.
Yeah, so I think there is something to be said for that, and some of our best things have not been that successful fundraising early days, and then something clicks. And
of the examples you cited, though, how many were minority or women founders?
It's too early to say. I mean, like 50% of our portfolio is.
No, I mean of the examples that you gave of deals that took a really long time to do. Were any of them?
Yeah, it's a good question. I'm just trying to.
I'm not sure that I know.
There's a handful. Yeah, there's definitely a handful. I think you're right. It's probably not the rule. It's not, maybe it's a little bit of the exception, but
I've had both on both sides.
Yeah.
We're like both, lots of different types of founders struggling in lots of different ways, and sometimes it goes quickly and sometimes it doesn't. But the difference being that certain groups of founders internalize why it's not going fast. And I'll just tell you, like my straight white male founders never think it's them. And sometimes it definitely is them. But, you know.
Sure, but is it internalization if it's like well documented implicit bias?
That
Is it
whole,
external
that is
or
a whole
external?
conversch that I would love to have
Okay, we'll do it
one-on-one
another
in a
time.
much
Sorry.
cooler room, because it's getting very hot in here. And thank you very much for coming. Thanks for And if you feel like you missed anything, the live stream will be up on the Brooklyn Bridge Ventures YouTube channel. Assuming I didn't run out of battery. Thank you.
That's the 15th, so. Flying out to India
Oh, by the way, I'm going to.
It's looking like.
Yeah, I figured out what
What?
to do.
It says looking like. Yeah. Going to the coffee on the 15th at Park Slope, so looking forward to seeing you again there. Yeah.